a lot of worry about the health of the municipal bond market and these states under stress. We want to get some perspective from Matt Fabian. He's senior analyst and managing director of Municipal Market Advisors. Matt, you heard the governor there say careening towards bankruptcy. Certainly a heavy debt load. States can't declare bankruptcy, though. But you think that there actually may be consideration of a law to change that?
Well, I mean, there is. I mean, there are sort of the conservative side of the Washington establishment is actually pursuing some kind of bill to allow states to declare some kind of bankruptcy. So, it hasn't been proposed yet. I mean, it may or may not be proposed, but it's something that the muni market in particular is watching very closely.
But what's the likelihood of actual adoption of that? You're also forecasting a congressional hearing in the near term. What does that accomplish?
Well, I mean, in general, it keeps munis into the headlines. I mean, you have to remember that Congress people and their staffers are just people like everyone else, right? So they're reading the headlines and seeing the releases, hearing the rhetoric like insolvency and bankruptcy, and thinking that we really need to get to the bottom of this and see if they're will these states in fact need a bailout, and if they do, sort of what should the federal approach be? So I mean, all of this is sort of good things in general. In particular to clarify the relationship between U.S. Treasury and the states. Although allowing states to declare bankruptcy is probably something that they almost surely would never use, but it would be very disruptive to the municipal market.
Right. It's more of the positive side would be a negotiating tactic. But if this was actually implemented, you think it would be negative for bonds?
For the bond market, absolutely, because I mean, if you think about the muni market, right? I mean, you have a state like Illinois with a very difficult budget situation, with up until this point very little willingness to try to correct it, but yet people who buy muni bonds, and remember the people who buy muni bonds are in general permanent lenders, right? Because munis are very difficult to sell, right? They're kind of hard to buy, very hard to sell. So when you buy a bond, you're pretty much going to be holding that thing to maturity.
But you get the benefit of the tax exempt status.
Well, that's right. But the principal reason why they buy something like Illinois is because of the very strong structural protections that the state law provides for the payment of bondholders. Because I mean, in effect, they are sequestering debt service almost a year ahead. So it's hard to see the scenario under which they would default. A bankruptcy rule could potentially change that. So it sort of adds instability to that one core of the municipal market strength.
When you're looking not only state by state but locality by locality, where do you see the most benefits right now? I know New York City, biggest municipal borrower after California's come into market.
Right. Actually, they just finalized a deal late yesterday, early today. The very longest bond yields. There was a 2039 maturity at a 5.33% yield. Those are very attractive yields. Historically, individuals want to buy 10-year muni bonds with about a 4% yield, 30-year muni bonds with about a 5% yield. Under this scenario, with all the headlines and all the bad news, you'd expect that those yields would be, a fair amount higher. The market is struggling to find a bottom at this point. I don't think we have found it yet. We are still waiting for demand to materialize and for outflows to stop out of the mutual funds. At some point, we may, hopefully soon we will find that bottom, but it's not clear right this week, that's for sure.